as a result of all of that. Just give me your view. Were you surprised when you saw it? Just talk to me.
I was surprised that the core rate went up the way it did. Everything was stronger than expected, I think, except for gasoline prices, which were negative. And there was a lot of hope that the gasoline price decline would offset the increases in other areas, but obviously that didn't happen. So, you know, the Fed is clearly in play again. I know now people are talking about 100 basis points.
Yeah, 40%. Market's pricing in that 40%. Nomura says 100. What does Gundlach say? 75,
I think. I mean, you can't. I'm always talking about how the Fed needs to stop oversteering. They start too late, and then they have to catch up, and then they just keep going until finally, you know, I call it Mr. Magoo. They're nearsighted, and they basically crashed into a dumpster or a tree or something. And that's what's kind of happening. But when you glue together some of the data and what the bond market has been saying, the only thing that makes sense to me is that the inflation rate is going to come down because of the Fed's aggressive activity. But what's the strangest thing, I call it the chart of it might be the chart of the year, if not certainly of the month, is the predictions on the CPI going forward. So the CPI was supposed to be transitory, right? They tried to get it up to about 4% or so is what I think they really were trying to do. And when it got to 4%, well, then it went to 5%. It was going to be transitory. And so they were kind of slow to do things. And then it went straight up to 9.1 on the headline at the peak. And if you look at the predictions of median economists, consensus economists, and if you look at market pricing, basically it says that inflation is going to go down almost exactly as fast as it went up. And if you look at the chart, it says inflation per these forecasters is going to go to 2%. And it goes so rapid decline from 9 to 2, and then starting in April or May of next year, then just go dead sideways, like a total L-shaped thing. That is the dumbest forecast you can possibly imagine because it's completely out of context of any historical experience. So what I think people are sort of worrying about in the bond market and starting to show up in the inversion and everything is that just as the inflation rate didn't stop at the 4 that they were hoping for, or the 5 maybe that they then were doubly hoping for, it overshot by 500 basis points. If inflation drops from 9 to 2 very, very rapidly, why wouldn't you think it would overshoot to the downside? You know, as if inflation is going to be under control, 9 down to 2, and then just 2. Actually, it's predicted to stay at 2 for like 18 months after that. If they overshot by about 5 percentage points on the upside, trying to get inflation from, say, 1 to 4, so it overshot by much more than the amount they were hoping to get it to, they're trying to get it from 9 to 2. Well, if it overshoots by the same sort of percentage, we might get the CPI going to -2, -3. I'm not predicting this exactly, but it's much more logical to me that that would happen than you would just have it stop at 2. And that's why people are actually not hating the long end of the Treasury bond market. Because but by normal comparisons, if there's an 8 or 9 inflation rate or a core inflation rate that's above 6, who the heck wants a 3.25, 3.50, 30-year Treasury? And everybody knows that the inflation rate is calculated differently than it was back in Jimmy Carter's day. And so if you use the same calculation technique as we used back then, inflation is really more like 11 or 12%. Who wants bonds at 3.50 when inflation is so high and they're struggling to bring it down? Well, the only solution to that, or the only thing that squares that circle, is the bond market is predicting that we're going to get a very significant decline in inflation. Once again, I think oversteering.